This video is for general educational purposes only and should not be considered financial advice. Cryptocurrency is a high-risk investment and prices can be extremely volatile. Cryptocurrency features, fees, security measures, and withdrawal processes vary between platforms and countries, so always do your own research before investing. Cryptocurrency is one of the most talked about investments in the world. Some people believe it will completely change the financial system. Others believe it's simply one of the biggest speculative bubbles ever created. The truth is probably somewhere in the middle. Crypto has created enormous wealth for some investors and enormous losses for others. In this video, we'll explain what cryptocurrency actually is, how people buy and sell it, the different types of crypto assets available, and most importantly, the risks every beginner should understand before investing. Let's start with the basics. Cryptocurrency is digital money that exists on something called a blockchain. Unlike the money in your bank account, there isn't one central bank keeping track of who owns what. Instead, thousands of computers around the world work together to maintain the same record. That shared record is called the blockchain. Every transaction is recorded and verified by the network, making it extremely difficult to alter previous records. Think of it like a giant shared spreadsheet that thousands of computers all agree on. You'll often hear another word when people talk about crypto: fiat currency. Fiat simply means government-issued money. New Zealand dollars, US dollars, Australian dollars, British pounds, and euros are all examples of fiat currencies. When you buy cryptocurrency, you're normally exchanging your fiat currency for crypto. When you sell your cryptocurrency and transfer the money back to your bank account, you're converting it back into fiat currency. So if someone says they're moving back into fiat, they simply mean they're changing their crypto back into normal government-issued money. So how do you actually buy cryptocurrency? Most people use a cryptocurrency exchange. An exchange works in a similar way to a share trading platform. You create an account, verify your identity, deposit money from your bank account, choose the cryptocurrency you want to buy, then place your order. Once you've bought your cryptocurrency, you can either leave it on the exchange or transfer it to your own wallet. Selling works exactly the same way in reverse. You sell your cryptocurrency, convert it back into fiat currency or a stablecoin, then request a withdrawal back to your bank account. One lesson many beginners learn too late is this: depositing money is usually very easy. Withdrawing it isn't always as simple. Some exchanges require additional identity checks before allowing withdrawals. Others have waiting periods, daily withdrawal limits, or only allow withdrawals back to certain bank accounts. There may also be withdrawal fees and network fees. Before depositing a significant amount of money, make sure you understand exactly how withdrawals work. Better still, test the process first. Deposit a small amount, buy a small amount of crypto, sell it, then withdraw the money back to your bank account. If everything works smoothly, you'll know exactly how the process works before investing larger amounts. Think of it as testing the emergency exit before you ever need to use it. Now let's look at the different types of cryptocurrency. The best known cryptocurrency is Bitcoin. Bitcoin was created in 2009 and is often described as digital gold. Unlike a company, Bitcoin doesn't produce products, generate profits, or pay dividends. Its value depends on supply and demand, adoption, confidence, and investor sentiment. Many investors simply buy Bitcoin because they believe more people will want to own it in the future. Whether that's true or not is something each investor needs to decide for themselves. The second major category is utility coins. Utility coins are cryptocurrencies designed to perform a specific function within a blockchain network. Ethereum is probably the best known example. The Ethereum network allows developers to build applications, smart contracts, and other digital services. People often need Ethereum to use those services, which creates demand for the coin itself. But remember, having a real purpose doesn't automatically make something a good investment. The project still needs users, it still faces competition, and investors still need to believe it has a strong future. Another important type of cryptocurrency is the stable coin. Stable coins are designed to maintain a stable value. Many aim to stay equal to $1. People often use stable coins when they want to move money around the crypto market without converting back into fiat currency. For example, if someone sells Bitcoin but still wants to stay in the crypto ecosystem, they may temporarily move into a stable coin instead of cash. But don't assume stable means risk-free. Stable coins rely on reserves, trust, regulation, and the organization behind them. They're generally designed to reduce price volatility, not eliminate risk altogether. By this point, you've probably noticed something important. Not every cryptocurrency is trying to do the same thing. Bitcoin is often viewed as a store of value. Ethereum powers applications. Stablecoins are designed to maintain a stable price. And later, we'll look at NFTs, meme coins, and several other parts of the crypto market. Understanding what you're buying is far more important than simply buying the latest coin everyone is talking about, because every cryptocurrency carries its own risks. One reason cryptocurrency receives so much attention is because its prices can move dramatically. Unlike many traditional investments, crypto markets have often gone through periods of rapid growth followed by significant declines. Over time, many investors have noticed what is often called the 4-year crypto cycle. While history doesn't guarantee the future, understanding these cycles can help explain why crypto prices sometimes move the way they do. Historically, Bitcoin has experienced a pattern that many investors divide into 4 stages. First comes accumulation. This is usually after a major market decline when prices are low and interest has faded. Next comes the bull market. Confidence returns, more investors enter the market, and prices often begin rising rapidly. Then comes euphoria. Social media fills with stories of overnight millionaires. Friends who have never invested before suddenly start asking how to buy crypto. Many people begin believing prices can only keep rising. Finally comes the bear market. Prices begin falling. Some investors believe every drop is just another buying opportunity. Sometimes it is, but sometimes that pullback marks the beginning of a much longer decline. Again, these cycles are not guaranteed, but they've been observed several times throughout Bitcoin's history. One tool many crypto investors use to understand market sentiment is the Crypto Fear and Greed Index. The index doesn't predict the future. Instead, it tries to measure how emotional investors are at any given time. The scale runs from 0 to 100. 0 to 25 represents extreme fear. 25 to 50 is fear. 50 to 75 is greed, and 75 to 100 is extreme greed. Think of it as a thermometer for investor emotions rather than a crystal ball. When markets are experiencing extreme fear, investors are often worried. Prices may have fallen sharply. News headlines are usually negative. Many people are selling because they're scared prices will keep falling. Ironically, this is often when experienced long-term investors begin looking for opportunities. When markets reach extreme greed, the opposite happens. Everyone seems excited. Social media fills with stories of easy money. Friends start talking about buying Bitcoin. New investors rush into the market because they're afraid of missing out. Unfortunately, periods of extreme greed have often been followed by significant corrections. That's why experienced investors try not to let emotions make their decisions for them. There's an old investing saying that applies just as much to crypto as it does to shares. Be fearful when others are greedy, and greedy when others are fearful. That doesn't mean buying every time the fear index is low. And it certainly doesn't mean selling every time the greed index is high. It simply reminds us that markets are often driven by emotion. Successful investors try to recognize those emotions without letting them control their own decisions. Another part of crypto that received enormous attention was NFTs. NFT stands for non-fungible token. Non-fungible simply means unique. Unlike one Bitcoin, which is identical to every other Bitcoin, each NFT is designed to be different. An NFT can represent ownership of a digital item, such as artwork, music, gaming items, or collectibles. When NFTs first became popular, they were heavily promoted as the future of digital art. Some people paid hundreds of thousands and even millions of dollars for individual digital images. The idea was that because each NFT was unique, owning one was like owning an original painting instead of a printed copy. But there was one major problem. Owning the NFT didn't automatically mean the artwork itself would continue increasing in value. As the excitement faded, many NFT prices collapsed. Today, many people believe a large number of NFTs are worth little or nothing because the demand that once drove prices higher simply disappeared. That doesn't mean every NFT is worthless. The technology may still have practical uses in areas such as gaming, event tickets, memberships, and proving ownership of digital assets. But as an investment, NFTs demonstrated just how quickly prices can rise during periods of hype, and how quickly they can fall when that excitement disappears. For most beginners, NFTs remain one of the highest risk areas of the crypto market. NFTs weren't the only crypto assets driven by hype. Another category that became incredibly popular was meme coins. Meme coins are cryptocurrencies inspired by internet jokes, trends, and online communities. Some have delivered extraordinary returns. Others have collapsed just as quickly. Unlike projects trying to solve a real-world problem, many meme coins depend almost entirely on community enthusiasm and speculation. That means prices can rise rapidly, but they can also fall just as quickly. If you choose to invest in meme coins, understand that you're usually taking on significantly more risk. One hidden cost that surprises many beginners is something called gas fees. Gas fees are transaction fees paid to use a blockchain network. Whenever you transfer cryptocurrency between wallets, buy certain assets, or interact with some blockchain applications, you may need to pay a gas fee. These fees aren't paid to your exchange. They're paid to the network processing your transaction. Sometimes the fee is only a few cents. Other times, particularly when networks are busy, fees can become surprisingly expensive. Always check the cost before confirming a transaction. By now, you've probably realized that investing in crypto isn't just about choosing the right coin. It's also about understanding market psychology, recognizing hype, and being aware of the costs involved. Next, we'll look at how to safely store cryptocurrency, explain hot wallets and cold wallets, discuss seed phrases, show you how to avoid one of the most expensive mistakes beginners make when transferring crypto, and introduce micro crypto contracts. Once you've bought cryptocurrency, you need somewhere to store it. This is where crypto wallets come in. Despite the name, a crypto wallet doesn't actually store your coins. Your cryptocurrency always remains on the blockchain. Your wallet simply stores the digital keys that allow you to access and control your cryptocurrency. Think of it like online banking. Your money isn't stored inside your banking app. The app simply gives you secure access to your bank account. Crypto wallets work in a similar way. There are two main types of wallets: hot wallets and cold wallets. A hot wallet is connected to the internet. This includes exchange wallets and mobile phone apps. They're convenient because they're easy to access whenever you want to buy, sell, or transfer cryptocurrency. However, because they're connected to the internet, they're generally more exposed to hacking attempts, scams, and cyber attacks. A cold wallet stores your private keys offline. Most cold wallets look like a small USB device. Because they're not permanently connected to the internet, many long-term investors consider them one of the safest ways to store larger amounts of cryptocurrency. Think of it like this. A hot wallet is similar to carrying cash in your everyday wallet. A cold wallet is more like storing valuables inside a safe. If you plan to trade regularly, a hot wallet may be more convenient. If you're planning to hold cryptocurrency for many years, a cold wallet may provide greater security. Whether you use a hot wallet or a cold wallet, you'll usually be given something called a seed phrase. A seed phrase is a series of words that acts as the master key to your cryptocurrency wallet. If your phone is lost, your computer fails, or your hardware wallet stops working, your seed phrase allows you to recover access to your cryptocurrency. Without it, recovering your funds may be impossible. Your seed phrase is one of the most important things you'll ever receive in crypto. Anyone who has your seed phrase can usually access your cryptocurrency. Treat it like the keys to your house combined with the PIN for your bank account. Never email it to yourself. Never save it in cloud storage. Never take a screenshot and leave it on your phone. Many experienced investors write it down and store it somewhere secure, with a backup kept in another safe location. As paper can be easily damaged, some investors stamp their seed phrase on a sheet of metal. Protecting your seed phrase is protecting your investment. Another mistake that has cost people millions of dollars is sending cryptocurrency using the wrong blockchain network. Some cryptocurrencies exist on more than one blockchain. When transferring crypto, exchanges often ask you which network you'd like to use. If the receiving wallet doesn't support that network, your cryptocurrency may become extremely difficult to recover, or in some cases, lost forever. Unlike a bank transfer, crypto transactions usually can't simply be reversed. Before pressing send, experienced crypto investors usually check three things. Is the wallet address correct? Is the correct blockchain network selected? And am I sending the correct cryptocurrency? If you're transferring a large amount of money, it's often worth sending a very small test transaction first. If the test arrives successfully, you can then send the remaining balance with much greater confidence. Taking one extra minute could save you thousands of dollars. Another term you may hear is crypto futures or micro contracts. These are advanced trading products. Instead of buying the cryptocurrency itself, you're buying a contract based on its price. Micro contracts are simply smaller versions of standard futures contracts. They're designed to allow traders to gain exposure using smaller amounts of capital, but don't let the word micro fool you. The risks can still be significant. Many crypto futures use leverage. Leverage allows you to control a much larger position than the money you've actually invested. This means gains can be magnified, but so can losses. If the market moves against you, you may receive a margin call, or your position could be automatically closed to prevent further losses. For beginners, futures and micro contracts are usually something to learn about first, not something to rush into. Understanding how they work is far more important than trading them. By now, you've probably realized that crypto isn't just about buying Bitcoin. There are wallets, different blockchain networks, transaction fees, security responsibilities, and advanced products such as futures contracts. Learning these basics before investing can help you avoid mistakes that have cost other investors a great deal of money. In the final section, we'll discuss one of the biggest mistakes new investors make: trying to sell at exactly the top, why taking profits matters, and why crypto should only ever be one part of a well-diversified investment portfolio. One of the biggest mistakes new crypto investors make actually happens before they buy. They spend hours researching which coin to invest in, but almost no time deciding when they'll sell. Having an exit plan is just as important as having a buying plan, because eventually every investment reaches a point where you need to decide whether to hold or take profits. Many beginners believe they'll be able to sell at the absolute top of the market. Unfortunately, almost nobody consistently knows where the top is. Markets don't ring a bell when they've reached their highest point. By the time it's obvious a market has peaked, prices have often already fallen significantly. Trying to perfectly time every top is one of the hardest things in investing. Another common mistake is assuming every pullback is simply another buying opportunity. Sometimes that's true. Markets often pause before continuing higher. But sometimes what looks like a temporary dip is actually the beginning of a much longer bear market. That's why it's dangerous to assume every falling market will immediately recover. Understanding the difference isn't easy. Even experienced investors get it wrong. Many experienced investors decide on a profit-taking strategy before they invest. For example, they may decide that if an investment doubles, they'll sell enough to recover their original investment. Everything that's left can then continue growing using what many people call house money. Others may choose to sell a small percentage each time their investment reaches certain milestones. There isn't one perfect strategy. The important thing is having a plan before emotions take over. Greed is one of the biggest reasons investors hold on for too long. When prices are rising quickly, it's easy to believe they'll continue forever. Fear can be just as dangerous. After a large market decline, investors often panic and sell near the bottom. Successful investing isn't about eliminating emotion. It's about recognizing emotion without allowing it to make your decisions. A written investment plan can help you stay disciplined when markets become exciting or frightening. Remember, cryptocurrency is just one investment option. It sits alongside shares, ETFs, bonds, property, precious metals, and many other assets. You don't need to own cryptocurrency to become a successful investor. If you understand it, believe it fits your investment goals, and are comfortable with the risks, it may deserve a place in your portfolio. If you don't understand it, don't invest in it. There will always be another opportunity. The biggest risk in crypto isn't always choosing the wrong coin. It's not understanding what you're buying, how you're storing it, or how you're moving it. The more you understand before investing, the fewer expensive mistakes you're likely to make. That's true whether you're investing in cryptocurrency, shares, property, or any other asset. Knowledge is one of the best investments you'll ever make. Cryptocurrency has created extraordinary opportunities. It's also created extraordinary losses. The difference has often been less about finding the perfect coin and more about understanding risk, protecting your investments, and knowing when enough profit is enough. Take time to learn. Invest only what you can afford to lose. And remember, successful investing isn't about owning every asset. It's about understanding the assets you do own. Thanks for watching. If you found this video useful, please click the subscribe button. It costs you nothing, but it can help the channel heaps. Here at Practical Assets, the goal isn't to chase hype, it's to understand investments, reduce risk, and build wealth over time. If that sounds like the kind of investing you're interested in, I'd love to have you along for the journey.